Hi there. If you own property jointly in the UK, it could dramatically affect inheritance tax. Today, we explain the critical difference between joint tenants and tenants in common.
Welcome. Now, what if I told you that when you die, your will, the one you paid good money for, could be completely ignored, and that your home, probably your single biggest asset, might not go to the people you intended at all? It's a really shocking thought, isn't it? Well, today we're going to get to the bottom of this. This whole guide has been put together for you by the expert tax advisors at My Tax Accountant, and we're going to explore how you own your property and what that really means for inheritance tax. Okay, so let's just dive right in with a really important question. If you own your home with someone else, do you know with absolute certainty who inherits your share when you pass away? I bet you're thinking, yeah, of course I do. It's in my will. But hang on a minute. A simple choice you made maybe years ago when you were just excited to get the keys could lead to a completely different outcome. And trust me, this is something that catches so many people out. You know, this isn't just some boring legal detail for solicitors to argue over. We're talking about your control over your biggest asset. It's about making sure your family is secure and that your wishes, well, that they're actually followed. It all comes down to two legal terms that sound almost identical but have completely different results. And getting it wrong can mean your share of the house goes to someone you never, ever intended. Right, let's break this down then. In England and Wales, there are really only two ways to own a property with someone else: as joint tenants or as tenants in common. I know, they sound so similar, it's easy to get them confused. But believe me, they are worlds apart in what they actually mean for you and your family. Getting your head around the difference is absolutely crucial. So first up, we've got joint tenants. This is the most common way, especially for married couples. The best way to think about it is like you're a single team. You and your co-owner are treated as one legal unit, owning the whole property together. It doesn't matter who put in the bigger deposit or paid more of the mortgage. You both own 100% of the whole thing, as one. The shares are equal and completely undivided. Now, the other option is tenants in common, and this is a totally different ballgame. Here, you each own your own distinct, defined slice of the property pie. It might be a straightforward 50-50 split, or it could be something else entirely, say 70-30, to show who put in what. The key word to remember here is separate. Your shares are yours, and they're separate from the other owners. Okay, this table here just lays it all out perfectly. And look, if you only remember one thing from all of this, let it be this next bit. Zero in on that row that says on death and the one below it, can you will your share? This is the absolute crunch point. As joint tenants, your share automatically goes to the other owner. No, you can't leave it in your will. But as tenants in common, your will is king. And yes, you absolutely can. This is the detail that trips so many people up. So what does this all mean in the real world? You know, what actually happens when one owner dies? Because this is the moment it all stops being theory and becomes a very, very stark reality. It's when that decision you made years ago suddenly has a massive and permanent impact. All right, so if you're joint tenants, this very powerful legal rule called the right of survivorship just takes over. And this rule is non-negotiable. It means your share automatically, instantly, goes to the surviving owner the moment you die. It completely bypasses your will. In fact, when it comes to the house, your will is basically irrelevant. But if you're tenants in common, your will is in the driver's seat. Your share is treated just like your savings or your car. It becomes part of your estate and goes to whoever you've named in your will. Let's make this crystal clear with a story. Imagine Peter and Janice. They're in a second marriage, very happy, and they own their home as joint tenants. Now, Peter has kids from his first marriage, and in his will, he's been very clear. My half of the house goes to my children. He thinks he's sorted everything out. But then Peter passes away. And because they're joint tenants, that right of survivorship trumps everything. The entire property automatically becomes Janice's. And Peter's kids, despite what his will says, they get absolutely nothing from the house. His wishes are legally worthless. Okay, let's switch gears and talk about the money, specifically inheritance tax, or IHT, because how you own your home doesn't just decide who gets it. It can also have a huge impact on the final tax bill your family faces. And this is where a bit of smart planning can literally save them thousands. Right, the big number everyone talks about is 40%. That's the standard rate for inheritance tax. It's a hefty chunk, and it applies to the value of your estate once it goes over a certain tax-free limit. And when we say estate, we mean everything: cash, investments, and of course, your share of the house.
So, as of 2026, that tax-free allowance for one person is £325,000. The official term for it is the nil rate band. Anything you own above that level is potentially in the firing line for that 40% tax. And let's be honest, with house prices today, it's pretty easy for a property to push an estate well over that limit, isn't it?
Now, for married couples and those in civil partnerships, things are much simpler. Anything you leave to your spouse is usually completely exempt from IHT. Simple. But for unmarried partners, it is a totally different situation. There is no automatic spouse exemption. The deceased share of the house gets added to their estate for tax purposes, even if it passes automatically. And you'll really want to listen to this next part, because this is where a massive and often completely unexpected tax bill can land on the survivor's doorstep. Okay, now here's a fascinating little detail, and this comes directly from HMRC's own rulebook. They actually admit that a 50% share of a house isn't really worth half of the total price. Why? Well, think about it. Who would want to buy just half a house? It's almost impossible to sell on the open market. And HMRC takes that practical difficulty into account when they value it for tax. So here's the key takeaway. For co-owners who aren't married, HMRC applies a discount. Let's walk through an example to make it simple. Say you've got a house worth £1 million. The deceased person's half is, on paper, $500,000. But HMRC applies a discount, usually around 15%. That knocks £75,000 right off the taxable value. So for tax, the share is now valued at $425,000. And at that 40% tax rate, that little discount saves the estate £30,000 in cold, hard cash. That's a huge deal. But remember, this is a really important point. This discount is for unmarried co-owners, not for spouses.
Well, after all that, here is some genuinely good news. You are not locked into the decision you made when you bought your house. Not at all. You can change how you own the property to match what you want today, to suit your family's needs, and to plan much more smartly for tax. You absolutely can take back control. And you do this through a pretty straightforward legal process called a severance of tenancy. All that means is that you're officially breaking that single team ownership of a joint tenancy and converting it into a tenancy in common. It creates those separate, defined shares that you each control. And interestingly, one person can actually do this on their own, as long as they let the other owner know. So why would you do this? Well, to make sure your will actually does what it's supposed to do, and to avoid a heartbreaking situation like the one Peter's family faced. It's for protecting children and blended families. It's for allowing much smarter tax planning. Basically, doing this puts you right back in the driver's seat when it comes to your financial legacy.
Right, here is my top tip for you today, and I really mean this. Go and do this as soon as you can. Find your property's title deeds. If you don't have the paper copy, no problem. You can download it from the Land Registry's website for just a few quid. And just look at it. It will tell you right there in black and white how you own the property. This one simple step is your first step towards peace of mind. And so that leaves us with one last really important question for you to think about. Knowing what you know now, understanding the huge difference between these two ways of owning your home, are you still sure that the way you own your property is the right one for you and for your family right now? Now, before we wrap up, I have to be very clear about this. Everything we've covered here today is for general guidance only. Everyone's situation is different. And when you're dealing with something as important as property and tax, getting professional advice that's tailored specifically to you is absolutely vital before you make any decisions. And to get that expert advice to really understand what's best for your circumstances, you should get in touch with the team that put this all together, My Tax Accountant. They are the experts who can help you navigate all of this and make sure your plans are watertight. Their contact details are right there on your screen. And hey, for more clear, helpful guides just like this one, make sure you subscribe to the My Tax Accountant YouTube channel. Thanks for joining me.